Hello and welcome to another episode of the SwingTrader Status Update. It's Justin Nielsen here, along with Mike Webster, our senior market strategist. And so let's talk about some of the things we'll be discussing today. We're going to talk a little bit about this precedent. This is something you went over on the Stock Market Today video with Ali on Friday, so we won't get too deep into the weeds. You've got a whole episode basically devoted to that. And then also we'll talk a little bit about where we're at in SwingTrader. We've got the Fed tomorrow, CPI, some risk events that are going to be, a reason for us to kind of keep our powder dry. And let's talk a little bit about that. So, Mike, we've been talking about dry powder. Can you just quickly describe what that means to you?
Well, dry powder is the opposite of wet powder.
Okay, there we go. Okay, moving on.
So, look, we're going into tomorrow, which pre-market, we've got the CPI, which is obviously market moving and important, but really late in the day is really where all the action happens. And that's when, Powell comes out. First he does his statement, and then, a little bit later, he does his press conference. Now, no one is expecting him to make any changes tomorrow. That's not even in the cards, but it's really the reaction to the new dot plots, the new information that he puts out there, and how the market reacts to that. And so what we wanted to do is be able to take advantage of the volatility that will, probably happen tomorrow. It might also happen on Thursday and Friday. And we wanted to have some room in the account to do some buying. So it was really being proactive rather than getting caught in the, all the whipsaw action that happens, during a big event like this. It's really about having some extra cash so we can put it to work, because we're going to talk about that precedent in a little bit. So we're very bullish on the market. So that's not why we raised cash. It was really to have this dry powder so we could have something to work with, some money to put to work rather than selling in the midst of, any whipsaw type of action. Because we all remember what happened a couple of Fridays ago where, we had the big down morning, and then, it came back strong. And then we're trying to get in front of that for future risk events.
Yeah. So let's talk a little bit about the precedent. So again, just to be clear, overall, very bullish, but we just know we're coming into a risk event. And so one of the reasons why we are bullish is because of this precedent right now. And look, we were talking about the 2003 a month ago, maybe a little bit more, but then we had that break of the 10-week moving average line that was really severe, and we kind of stopped talking about the 2003 market for a while. But now that we're recovered back at highs, this is starting to look a little bit more like 2003 again, and we went ahead and we added 2009 into the mix. So this is kind of why you're leaning bullish.
Exactly.
In addition to the power trend, we should mention that as well.
Yeah. So again, for more details on this, we did go over this, Ali and myself on Friday. Justin was nice enough to spend all the time that he did not have putting this together for us. So thank you so much. And essentially that red line there, that is where your follow through day was. And then you can see that, the blue up on top, that's where we are as of last week. So as we haven't had time to update it, but it was looking pretty much identical to those, with the exception of that one bad break that we had, which was why the way it happened was different than the 03 and 09, although the percent loss was pretty much the same, 7.6 and 8.1 for the historical examples and 8 for our market. So once the power trend started back up, I started looking at these again, and then Ali brought it up on IBD Live in the morning. And so we, just were bringing it back out on that SMT. So in a nutshell, what does this mean? Precedents are good until they're broken. And so right now, this precedent is holding for the 03 and 09 recovery phase and the power trend portion. And you could see that, we would, if this continues, we have, quite a ways left still in this uptrend, and before it goes into an intermediate correction, and then they resumed higher after that. So we want to take advantage of this time frame. So that's why we're deep in the market, but we did just kind of ease off the gas pedal yesterday and today just so we would have some space to, slam it down if we get the opportunities. Now, we don't know how tomorrow is going to play out. We don't know if we gap up and reverse down or vice versa. So we can't tell the market what to do, but we wanted to be prepared and in the right position if we get what I'm looking for are upside reversals, if at all possible, but it might just be breakouts so we have to buy in. We prefer upside reversals because the stops on those are a little bit more logical and easier than just a breakout type of buy, but you do whatever the market gives you.
Mm-hmm. So let's talk a little bit about this. And to be clear, the power trend hasn't ended, right? It's not like it really started back up again. It just it's been in force. There was some distribution, but I mean, the volume was really kind of weird for a little while as the meme stocks went a little crazy. And look, here we are. I mean, we really had some pretty ideal action after the strong Wednesday last week. We just really went super tight, and then here we are kind of breaking out of that little tight area today. So I mean, again, there's certainly reasons to be bullish, but look, we also were thinking that the Russell 2000 was looking a little bit stronger on May 31st. That didn't come to fruition. On this day right here, there were a lot of things that looked like they were setting up XLP, XLU. There was a whole host of things that were looking strong on that May 31st. Looked like we were going to have some rotation, and that didn't come to pass.
Yeah, that's been very frustrating. The constant rotation or setting up like of the small caps, the mid caps, or just sectors other than really technology and retail that every time they look like they're going to start going, they just get sold into just at the very beginning. So it is very frustrating, but it is reality is the market that we have. And so we trade the market we have, not the market we'd like to have. And so we're focusing in on that RS line, which is the green line there, and just trying to go to the space where it makes more sense. So look at that RS line now, toggle over to Qs and see there's a big difference there between how that's trending up nicely and above the moving averages. That's why we have the QLD on, which is the double of the Qs to have exposure here. We also have the SMH on as well to have exposure into what is the hottest group for this particular bull. So it is frustrating. The whipsaws get to all of us as much as it gets to you, but it's the reality of a bull market.
Yeah. So you talked a little bit about the how we have our tech exposure with QLD and SMH. We do have exposure to a lot of different areas. Let's talk about this pie chart that we have here. This is kind of showing how our money is distributed. And right now we do have 10% cash, as you said, a little bit of dry powder, hopefully to pick up some of those reversals. But there's a lot of retail, software mildly represented, apparel, and a lot of that is your shoes. There's a couple of a lot of shoe companies that look interesting. So, and medical has been looking a little bit stronger here recently. That miscellaneous is represented by our ETFs. So again, QLD and SMH are in there. But anything to add on this, Mike?
No, I think when we were talking pre-show, you had pointed out, that we don't really have a lot of direct technology. So that's something that we are, of course, SMH and the QLD and things like that. But that is a space where we're going to want to, add some. And, looking at this, I think we do have enough of the retail space, although that is another, hot sector. So looking at your own account, you should do the same thing and do it on a regular basis to make sure you don't accidentally get too heavy in one space just because there's a lot of setups, in that area. You want to make sure that you're spread out to deal with the constant volatility that we have, but also making sure that you're in the hot area. So we certainly want to get some more like chip exposure, and just more really into the AI space, but we have to have the proper entries.
So let's talk a little bit about one of the issues with some of these tech plays is a lot of them are extended, but they have been giving maybe some alternative buy points. The problem has been that a lot of them also tend to be on the higher side of volatility, higher ATRs, average true range, meaning that they tend to move a lot. And if you're trying to keep your stops very tight, 4% or lower, and you've got something with a high ATR, well, what do you do?
Well, we're going to adjust. And so that was one of the frustrating things. Maybe let's pull up one of them. Let's pull up First Solar.
Okay.
So this is one that we were looking at yesterday to add to SwingTrader. And then because the average true range, how much it trades on a regular basis was so high, and where our stop was going to be was so far away, it was more than the 4% that we like to, we try with SwingTrader to have a 4% maximum loss, if we can at all help it. And it was just before we knew we were going to be wrong, it was going to be more than 4%. So we didn't do it. Now, I did end up buying it today on my own account, but it's things like this.
I ended up buying it as well. So
did you? Okay, we didn't even talk about it. So we're missing things like this where the heat is, and why our performance isn't where we want it to be, because where the action has been in these volatile stocks that we just couldn't do within the constraints of a 4% max stop loss. So what we're going to be doing, and that's why we wanted to kind of talk about it today, is we're going to start doing quarter positions for some of these at the very beginning, meaning a full position on SwingTrader is a 10% position, 3/4, 7.5, a half, which we've been starting most positions at. A half is 5%, but we're going to be starting a lot at 2.5 as far as in this space of high volatile stocks. So what does that mean to you? If you're going to follow us along with your own account, just make sure your position size is such that you're fine with a bigger stop than 4%, so we can start participating in these, because really that's frankly a large part of the reason why the performance hasn't been the way we want it to be, is because we've been getting stopped out of the things because our stops are on the tight side, and we're missing out on the really good merchandise that just is a little bit more volatile than our stops would allow. So we're iterating, as you always say, Justin, and is what Bill taught us to do, is just always adjusting, always learning and adjusting. So that's what we'll be doing. So don't go in, if you see a First Solar type of stock go on, don't go in there with a full position. Look and see what size we're putting it on, and that shows up in the alert and it shows up on the website. So pay attention to that. Don't just think we're putting something on and go in with the same size. Just do it proportionally to what we're suggesting.
Let's talk a little bit about medical, and one of the stocks we can talk about here is Regeneron, where we were taking some off and then we were putting it back on. What was the kind of reasoning behind that?
Yeah, so we're trying to do SwingTrader the way we really trade, and that is, you don't just buy it once and forget about it. You either buy it and you're offensively selling or defensively selling, and then buying back when it makes sense. And yesterday we were actually for a few days we were frustrated that you really couldn't get above this 1,000 level in any meaningful way. And when you're around,
reminiscent of Intuitive Surgical, right at the 400 level, where it just seemed like it got stuck for a while, for Intuitive Surgical, and then it finally went. And I do have a position in Intuitive Surgical, but then Regeneron was kind of stuck right around that 1,000 level, and we were almost afraid it would do the same thing.
Exactly. Yeah. And I've been trading both of these in my personal account as well. And so with this one, because it wasn't able to hold that 1,000, we wanted to back away from some of the position. But then today, when it was able to make it back through it again and it was looking stronger, then we increased that position back from a quarter to a half. And so that's what you'll see more of as things. We did it with on as well. We increased our position there on the shoe side. I do have a position in that.
I have a position on as well.
And so this one is kind of formed a little kind of pause there, kind of shellfish-like, holding above 40 and well above its 21-day, which is the green line there. And breaking out, we wanted to, increase exposure to this because it should move higher if it's going to act normally. And if so, we wanted to have more exposure there. Now, if it backs away, we'll have to back away from some of it. And then if it comes down enough, we'll have to back away from the entire position.
So let's go ahead and maybe we can end on the note of SPY. This is one where, I mean, look, there's a reason why there's a lot of closet indexers out there, right? It's sometimes really tough to beat the index. And we did have SPY, but you kind of wanted something else. What did you want?
I wanted double. So with we had been doing the Qs, and then we switched to the QLD, which was the double of it. So it's leveraged 2 times. So we wanted to go with the SSO. And we didn't want to confuse people by just adding SSO while we had SPY on. So we removed SPY to allow us to, without confusion to everybody, because of course we're not doing these, we're only doing these once a week, can't do them every day. And we just didn't want to throw people off by adding the double of SPY while SPY was still on. So we cleanly removed SPY yesterday, and we were hoping that we have an upside reversal or some other way of getting into the SSO, which is the double of SPY. I'm personally trading UPRO, which is the triple of SPY. And I just think that that's a little bit too much for SwingTrader right now. Once our performance gets better, then we will, look to do triples when it makes sense. But we want to take baby steps and go from a single to a double.
So from the mailbag, we did get a question that came in, and someone was asking about when you're using the leveraged ETFs, are you setting your stops based on that stock chart, or are you looking to the underlying? So for example, if we had SSO or we do have QLD, are you looking at QQQ for your Qs, as it were, the Qs as to when you're going to sell? Or are you using, okay, look, I'm just going to use the QLD chart to kind of make those determinations?
I use the original. So I use the single as my areas. And then on that where, a low is. And then you go over on that same date and time, and you go over to the double or the triple and use that. Just because they act differently because they're a double or a triple. So yeah, I don't want to use anything else on the chart. It's just a way of getting that exposure. So if I'm trading QLD or TQQQ, which I have, then I'm going to base all my decisions off of Qs. With SSO or UPRO, I'm going to base everything off of SPY and so on.
So speaking of SPY, so for this idea of kind of getting out of SPY, and look, a lot of what the thought process here is that we could easily see the market come in a little bit, knock out our stops, but be okay and end up, closing well. Again, like we saw on May 31st, that's this day right here where it tested the 21-day moving average line, closed above it, but spent quite a bit of time underneath it. Same thing for the Qs, spent some time underneath its 21-day moving average line. But now with these kind of moving up higher into new high ground, what does the entry look like?
It's going to be tricky. If there isn't one, we're not going to do it. So we have to have a logical entry. Like today with an outside day on SPY would have been perfect to add the SSO on. And we didn't do it because we're going into the risk event of tomorrow morning. And we didn't want to just put it on just to be in a position of kind of weakness. Let's say it's a hot CPI number and we gap down, and then later we end up coming back with something Powell says, or vice versa. We just didn't want to be under that same pressure that we were last Friday. So we're just kind of living and learning and just saying, okay, we're going to remove it. And then if it doesn't give us an entry, we'll use that capital. I mean, we're essentially 90% in. So it's not like we moved out of the market. We just moved from slightly on margin to 10% cash. So it's not like we're trading slow and pokey, but we did want to have that space for SSO or anything else. And so we're not going, if it just gaps up and just moves higher and it's not logical to enter it, we'll just have to pick something else and wait for a better spot. I really like today's days like today, that's ideal. Like an outside day, your high and your low is higher and lower than your prior day, and closing at the highs, that's picture perfect. Like you can't ask for more than that. But we have this risk event tomorrow. So you either trade as if you don't care about the risk events, which there's nothing wrong. That's actually a good way of trading, because there's always risk. I think you said it on IBD Live the other day of, you've got CPI, PCE, unemployment, the list goes on and on. Then of course, before you know, we're going to have the election concerns, in November. So you'll always have things to worry about. So you can just trade the chart. That's one way of doing it. But because of the volatility, especially like we had last Friday, also like a month ago, on those downside reversals that we had, we want to be cognizant of what is going on, because this product does have tight stops. And there's one other thing that we did talk about that we want to make sure that we let everybody know. We are going to try to let things go a little bit more against this intraday and make those decisions in the last hour. I think IBIT is a perfect example. We were kind of forced to sell it this morning because it was underneath every area of support. I kept a lot of it in my personal account because I wanted to wait for the close. But for this product, it was best to close that out with our current strategy. But we're just wanted to let everybody know first, so you weren't caught off guard of like, why are they letting these go against them, is we're going to intraday let it tell us more information, wait for the close to pull the trigger. So if we would have closed near the lows, then we would have removed it. I mean, we removed it earlier today. We didn't really want to, but we kind of forced to. But given this close, if we would have waited until the last hour, we would have held it. So that's exactly why we're doing these every week, to be able to relay to everyone what, how our strategies are changing. And that's what Bill did. Bill was always changing. If you look at how he traded back in 1962 through the 70s, was different than how he traded in the 80s and in the 90s. And then when I was trading with him, he changed a lot too. He was always just changing as the market evolved and how his risk profile evolved as well.
Mm-hmm. Well, I think this is probably a good place to kind of wrap it up. We also have to thank.
One thing?
Oh, go ahead.
One thing. I just hope that you have a wonderful trip with your family. You deserve, of all people, you are the saint, and you deserve a wonderful family vacation. So I'm so happy for you. We will miss you. I will text you to say have fun, but I won't text you about work.
It's just a week. It's just a week. So and I know everything is in able hands. Dominic Gessel, of course, in the background today, running show as producer for the first time. Excellent job, Dominic, and thanks for that. And thanks, Lily, for holding his hand through the entire process. But now, hopefully, he doesn't get put onto more things like, oh, Dominic can do the producing job. Let's see if we can just nab him for all these other things. But anyway, thanks a lot for joining us this week. And next week, it's going to be Chris and Mike on their own with Dominic producing in the background. So hope you enjoy that, folks. And I'll see you in a couple weeks. Take care.